everyone, Donna here with Bookkeeping Made Simple. This is the show where we talk about everything to do with business. And by that, I mean everything from mindset and leadership and what books to read and what, how to develop better habits and time management to accounting and what to do with your money, how to manage it, how to, how best to leverage it. There's a lot that I cover. The emphasis is on accounting because guess what? I'm an accountant. And for those of you that don't know, I'm finishing my master's degree in accounting. I have a bachelor's in accounting and an MBA. And I do have a staff of bookkeepers that work for me that I am very confident in. I do a lot of work with them. I have a fantastic team. So with that, I want to start by, and I'm going to remind you to, if you enjoyed this, if you found it entertaining, at least more entertaining than a regular high school or college accounting class, or I said something that helped you, please like, share, and subscribe. Ring the red notification bell on YouTube so you get notified when new videos drop. We are on Spotify and on YouTube and a few other places, but it's all done through Spotify. So with that, I'm going to go ahead and get started. Today's topic is the balance sheet, and specifically some challenges that we have as bookkeepers and accountants getting information onto the balance sheet. It is absolutely critical that your books are accurate, and that doesn't mean that they have to balance down to the penny. That is virtually impossible, except for the very smallest of businesses, and that just has a lot to do with business accounting. But one of the things that I notice a lot is that clients are very hesitant or neglectful, one of the two, of making sure that everything that should be on the balance sheet is on the balance sheet. Well, what should be on the balance sheet? If you have purchased assets for your company, it could be a computer. It doesn't seem like it should be there, but it should be there. A computer, office furniture, vehicles, equipment, copy machine, especially if you have one of the bigger ones, not this one, but a bigger one, like an office one. This was only $300, but anything like that, that is an asset. Those are assets. These are things you can sell and make money off of. So like I said, vehicles are a huge one, and then manufacturing equipment is a huge one, but it also does include copiers, printers, office furniture. So if let's say you're a therapist or a physician and you need to have a specific, an office where people are coming in to meet with you, you want to have that look nice, right? So your decor can be tax deductible for one thing, but if it's a desk, computers, one of my friends who's also a tax preparer has a big TV in her office so that it's easy for her to explain tax returns to her clients. All of that are things that should be on the balance sheet. On the other half of that, if you took out a loan to purchase this stuff, all of the loans have to be on the balance sheet. And when you go to take out a loan or to obtain capital, what you are going to do is you're going to submit your balance sheet, and all of that has to be correct. Now, banks are going to, and underwriters are going to look and see, are there assets to go with the loans? In other words, if I report a car loan and I don't have a car on my balance sheet, they're going to question that, and they're going to say, why are you paying a car loan when you don't have a car? Now, what happens a lot of times is, one, clients forget. They forget to notify us of these asset purchases. It is critical because we can deduct depreciation expense. And although the Tax Cuts and Jobs Act is sunsetting, we can deduct up to 60% for 2024, 80% for 2023, but 60% for 2024 of the purchase price as kind of a lump sum depreciation in the first year of purchase. And then we can depreciate the rest of that over time. However, if we don't know what your assets are, we can't help you cover your assets. Okay, it was a horrible, horrible joke. I'm sorry. But we need to know what your assets are. We also need to know what your liabilities are. And there's reasons for that too. If you have a car, you may have paid cash for it. That's fine. But we want to make sure that you are in a good financial situation. So if we don't have all of those liabilities on the balance sheet, now it becomes difficult for me to do any analysis of your financials. And what that means is I go through and I see what your liabilities are, what your assets are, what your cash flow looks like, and can you afford to take out another loan? So there's a number of ratios that we use to determine if your business is healthy. And one of them is called the current ratio. So your current liabilities versus your sales. We want to make sure that that is a good number. We also want to make sure that you are not just overextending yourself. That happens a lot. So what will happen is clients will be in profit because their income less their expenses is still a positive number. But they forgot to mention that they have loans on their assets. That's a whole different thing. So your profit is on your profit and loss. That is simply sales or your revenue less your expenses. That's all that is. Or your revenue less your cost of goods sold, if that applies to you, less your expenses. And the bottom line is your profit. But that doesn't mean that you're in a good position as far as cash flow, which we also need to know about, or that you're in a good position when it comes to your balance sheet. We want to see that you have more assets and liabilities, but we also want to make sure we're reporting all of the liabilities and all of the assets. And there's a number of reasons for that. One, like I said, bank loans. If you're going to get financing for your business, you need to have all of this reported on your balance sheet. I've had clients say, well, I don't want to put the liabilities on that because it makes me look bad. But you're really missing out on one, making sure that your taxes are correct at the end of the year, because we take the balance sheet and that's part of what we need to do taxes. We need to know what all these liabilities are so that we can reduce your tax burden as much as possible without necessarily making it look like you just didn't make any money. We also want to make sure that those are being reported correctly to the IRS, and that, again, the underwriting, if you need to ever take out a loan of any kind for your business, they're going to look at that. But again, the biggest reason we do bookkeeping isn't for the banks, and it's not for the IRS. Tax accounting is different from management accounting or financial accounting. And that's really what we do. My emphasis is not on making sure that it's tax deductible. It's making sure that, one, I, as the tax preparer, have the information I need to do the books, to do the taxes. And more importantly, the second one is you, as the business owner, should have all of the information in your books to make sure that you know what's going on in your business. So if you look at your balance sheet and you see a lot of liabilities and you see that you're upside down in life, you don't have any more assets, but you have a lot of liabilities, you have a lot of credit cards, you've been leveraging a lot of things, then we can make a plan together to help you pay off some of them so that you can have a healthier business, so that you can keep more money in your pocket. So with that said, it's really, really common that we start seeing loan payments with no loan, or that we start seeing, well, that's really common. Loan payments with no loan, credit card payments with no credit card, assets coming in the client has purchased and we have no idea about, because in the end, we don't know anything our clients don't report to us. So when you're purchasing an asset, anything over like $300, we need to know about it, and we also need to know what it was for, so we can decide, does it need to be capitalized? In other words, does it need to go on the balance sheet to be depreciated, or is it something that can be expensed? And in some cases, like I said, under the Tax Cuts and Jobs Act, we have the subsection 179 deduction. We might be able to take some as an expense and some as depreciation later. But again, we have to know about it to be able to give good advice. You need to know about it and have it on your financials so you can see exactly how your business is going. That's one of the biggest mistakes I see small business owners make, is just not telling us anything. The other big mistake that I see small business owners make as far as our clients is not responding to emails. It's really, really tough to accurately do the books if we're not getting accurate information. So we need to get the information from our clients, and the clients need to be a little more proactive about making sure that we get that information. So with that, I'm going to go ahead and close it. This is going to be just a really, really short video today, but I wanted to make sure that I talked about this because we do have bigger clients that are trying to get capitalized, and then they're trying to leave things off the balance sheet because they think it's going to make them look better, or they'll forget to tell us about all of it, and we need to make sure that those books are in place, or those assets are in place, so that the books are accurate. There's a lot that goes into this. It's a little bit much for just one quick video, but I wanted to talk about it. It really is important. It is really important to keep your books in order. The other half of, by the way, of making sure your assets are on your books is when you go to sell one. So let's say you buy a car for your business. Maybe you're a realtor and you spend your life in your car and it's time to buy a new one. Or maybe you do DoorDash or Uber or something. Or you needed a service truck to do mechanic work, whatever it is. Let's say you buy a vehicle for your business. You use it for 5 years. That's usually the depreciation schedule. Let's say you use it for 3 years and you decide, it's getting to be too much trouble. I'm spending too much on maintenance. I want to go ahead and sell it and buy a newer one. We need to know the original cost of that item, of that asset. We call that a cost basis. We need to know what you paid for it. So let's say you are in the trades and you have a truck or a van that carries your equipment and anything you're going to install. I'll use HVAC as kind of an example because I've had several heating and air conditioning clients. So let's say that you have a truck and or a van, and you let your service providers, your installers, go out and drive this van. And this is where you haul around air conditioning, furnaces, tools, equipment, anything like that. And over time, and in order to put it in service, you put a wrap on it because you want to advertise your business. That is part of the purchase price of the car, of the vehicle. Also, let's say you need racks put in it, and shelving and drawers so that you can have your tools in there, or you're putting a whole toolbox in there. That also is part of the basis of your vehicle, because that's some things that had to be done to put it into service for your business. You couldn't take it out and just use it as a regular cargo van, let's say, until you put some racks in there to hold your tools. So that's also part of the purchase price. We need to know about all of that so that we can accurately depreciate it and accurately track it. And just so you know, yes, that's all part of the purchase price. We don't have to expense it. We can take that initial depreciation and we can depreciate that over time. That can be very useful to you when it comes to tax time. So that's just what I wanted to talk about really quick. Do not hide things. Treat your bookkeeper and accountant like you do your doctor. I always laugh and say that I don't keep anything from my doctor because the smallest change of symptom could be the sign of a big problem later. Also, the doctors have already seen everything, especially if they work in the ER. So I assume they've seen it all. They've seen a lot worse than I can ever come up with. And so there's not going to be any surprises. They're not going to be rolling their eyes at me. I talk to a lot of people who say, I'm so embarrassed about my books because I used another accounting company and they didn't do a good job, and I'm just so embarrassed. I must have the worst books you've ever seen. I assure you, probably not. I have seen some really, really creative bookkeeping. And anytime you hear an accountant use the word creative in front of either accounting or bookkeeping, what you can actually hear is fraud. So I have seen business owners juggle things. I've seen them just move money around and they think they're being smart. But there's times when I can understand it, and then there's times when it does look like money laundering. So you have to be careful with that. And you have to be very upfront with your accountant or bookkeeper, because again, we've seen it all. I mean, I have seen really, really, really bad books. And I have been in books where I have literally within a couple of weeks been, this business is going under because they're being embezzled from. So there is that. So unless you are Enron or WorldCom or SBF, what is the FTX, whatever it was, Samuel Bankman-Fried, whatever it was that he was doing, unless you're in that firm or you have been working with Elizabeth Holmes, I promise you, it's not that bad. And with that, I'm going to go ahead and close the video. I'm looking forward to talking to you again soon. If you have any questions, comments, or a topic you would like me to address, please feel free to drop a comment below, and I do read them, and I will respond. So thanks, and I'll talk to you soon.